This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My podcast keeps getting diverse and diverse and diverse. It is so much fun to just go out and find this wide assortment of guests. To just reach out. What's my process? It's pretty much random. I mean, of course, it's not random on some things. It's not random to ask particular traders that I know of. It's not random to ask Daniel Kahneman to appear on my podcast. But there are many people that come on my show that are literally the result of me reading an article and saying, wow, that person is really on target for their particular world. And it's amazing how easy it is to find an email to just about everyone. Now, I guess my little system of asking noteworthy people to appear works pretty well. I'm not going to give away my secret sauce for how that happens. But let's just say it's pretty easy to reach anyone. If you've got something to say and you can possibly help them. It's a win-win situation, right? I win by having bright people come on my show. They give insights, people listen. They win by spreading their message. My guest today is Mike Dever. I believe this is Mike's third appearance on the show. If I'm wrong, I'm wrong, but I'm almost positive it's his third appearance. I will say this. He was my very first interview for this podcast series, giving some faith in me all those years ago. I guess in early 2012 was when Mike came on. He's an American businessman, futures trader, entrepreneur, and author, the founder and CEO of Brandywine Asset Management. Founded that in 1982. He has seen a lot of trading and knows probably just about everybody in the industry. His best-selling investment book, Jackass Investing, Don't Do It, Profit From It. Bottom line, Mike brings a world of experience, and damn is he's so crystal clear. I hope you enjoy this conversation with Mike Dever.
Hey, Mike here.
Hey, Michael, how are you?
Very good. How you been?
Not too bad. I was looking at my lengthy list of podcast episodes, and I was like, wow, I'm talking to the very first interviewee tonight.
Isn't that impressive? Yeah, it's great.
Well, I appreciate you giving me some. You're the start of the chain reaction. If you don't, if a guy like you doesn't talk to me for the first one, the next guy won't talk to me. So.
No, you've done a great job with them. I've been watching them and reading through them and listening. I mean, I've told people. I've used that as a like a badge of honor that I was your first. I've told people that over the last couple of years.
Well, it's funny, we exchanged texts. I think I'm paraphrasing a little bit, but you kind of gave me a little bit of that. Well, Mike, you've got that trend following focus. I don't know if you can handle where I'm at right now. And I was like, hold on. Toby Crable came on, and Toby's in a completely different world than the trend following traders too. So
that's true. And it wasn't meant to be a challenge or an insult. It was just, I wanted to make it clear that would be my talk. It's more about turn driver based approach and stuff. But
as I'm sitting here with 30 plus pages spread out on a table, I hope the audience they can't really imagine unless they see the presentation, but there's no shortage of detail in the current presentation that I've been going through and it's nearly a book in of itself, I think. So good stuff. Hey, let me jump right in though, because I think there's something really interesting that you're doing. And as you say, your current approach is multiple and in italics, fundamentally based trading strategies in a systematic, diversified portfolio that trades across more than 100 global financial and commodity markets. So you're really laying down the challenge, not to me, but you're laying down the challenge to to the investing world of like, I believe that I'm doing something unique?
Maybe. I do think, and we've gotten feedback from a lot of people that we presented to that we are doing something unique. I've heard that many times, and in conversations or in presentations, we'll ask, who else they would see that's doing something similar, or who they would compare us to, and quite often they come up blank. And these are some big institutions that have, met with, hundreds, if not thousands, of managers over the years. So, but I don't know if it's a challenge or anything. It's just our approach and our belief that you can get the most persistent, most consistent, and predictable returns by being balanced across a broadly diversified portfolio. And we don't just mean across market diversification, but strategy diversification.
Well, I think what's really cool, though, too, and I put aside opinions as to whether or not you think you're different or whatnot. From a correlation standpoint, you make the case that compared to major stock and bond markets, hedge funds, CTAs, trend followers, you don't have correlation.
That's correct. We're really uncorrelated to everything. People, because of the registration, they say, well, you're a CTA. We've already got a CTA exposure in our portfolio. Well, our correlation is 0.06 to the B Top 50 and the New Edge Index. There is no correlation to CTAs, even though we're trading in the same markets. We're using futures to execute our strategies. So we are obviously doing something different. We talked about it for a number of years, but the data actually obviously supports that.
But that's by design. You are looking at the investing world. You're looking at what allocators are doing, and you're saying, well, since correlation is an extremely important factor for how people either should or will make an investment allocation, by design, you have found this non-correlated combination of return drivers.
Yeah, I guess the correlation itself wasn't by design.
Really?
It's just the outcome of our belief and our approach, which is broadly diversified, balanced across a portfolio of strategies and markets. The end result is it's going to end up being uncorrelated to anything else. But we didn't start out saying we're going to create an uncorrelated program. We started out saying we want to create a program that can give us the best risk-adjusted returns in the most predictable fashion, so that we can look at the tested performance that we've done, and we can say, we got a pretty high probability of that recurring again. And you get that by having that broad strategy and market diversification and balance in a portfolio.
Michael, put your teacher cap on for a second and dissect the word predictable from your perspective and what you mean as you explain that to the audience.
Okay, I did a talk a number of years back with a group that had me in there talking about what the title of the presentation was, the fatal flaw in mean variance optimization. It goes back, in my talk, it went back to the late 1980s when we were developing a number of different trading strategies and updating the back tests on those across dozens of different markets. And I had hired some people to tell me how to allocate across the portfolio, to those strategies in those markets. The one person came back with, after I gave them maybe 30 markets with 15 strategies, and a lot of the strategies were trading in the same markets, so there were, a couple hundred at least strategy market combinations, and they came back saying, here's the allocation. And it was predominantly in one of the strategies trading in the silver market, and a couple of the other strategies trading in some of the other markets, and most of the rest was just null set. There was nothing allocated to them. And I said, well, the results are wrong. I can't do this. It's clearly not the right answer. He came back saying, no, that's the perfect answer. And what I realized is we were asking the wrong question. And the question that everybody assumed you were asking was, how do I optimize my performance given these inputs? And they were coming up with the ideal allocation so that you got the best risk-adjusted returns. You're out on the efficient frontier. What I realized pretty quickly was that is the wrong question. What we should be asking is, how do I get the most predictable performance so that whatever results you show me after I run this historical data through your model, I have a high probability that I'm going to get that same type of performance going forward. And it may mean that it's bad performance. It may not be good, but at least it's predictable. So we set out and we created a allocation model, and this really gets down to a couple different stages in the development process to make this work. But one of the key components is the allocation model, which we kind of referred to as our predictive diversification portfolio allocation model, that is solving for predictability so that the past and the future look as similar as possible rather than optimization.
Just to clarify a little bit further, so for people that are listening, you're not sitting back and you're saying you know what's going to happen tomorrow. You're looking at this more from a stats perspective, a probability perspective, and that's how you're using the phrase predictability.
Right. We actually, because we don't think we have a very good handle on what's going to happen tomorrow, created a model to allocate across this diverse array, matrix of strategy market combinations to give us the highest probability that if we're wrong in any single place, it's going to have minimal impact on the portfolio, and overall the portfolio will have the highest probability of repeating in the future what it has done in the past.
Let me jump back to something. When I was reading that introduction piece, that opening line from your presentation, multiple fundamentally based trading strategies in a systematic diversified portfolio. And then I've seen you also have said you're not purely quantitative. Why don't you explain that and talk about the testing aspect? Because you are taking, it's got to be a different type of infrastructure, a different type of system you put together, because clearly in the trend following world, you're looking primarily at one thing. You're just looking at price. Your world, you're looking at, there's a lot more coding, I'm imagining, that's involved.
There is, and we developed a platform which we refer to as Cadence, which is our research and trading platform. So we can use Cadence to develop any type of strategy that we come up with, and then just essentially flip a switch, and it's now, instead of generating historical performance, it's generating real-time trades that gets put into the rest of the system for execution. The difference for us, the difference is that we get down and we say what we're trying to do is capture return drivers. The return driver is the underlying condition that drives the price of a market. With trend following, the people that say they're trend following and they have trend following methodologies, I have no objection to it. I think it's a valid return driver. I think the fact that not everybody accepts the information that's been presented to them at the same time, they react differently, it means there's no super efficient market like people have been preaching in academia for a number of decades. It means that the same piece of information may take one person a second to respond to it, or nanoseconds in today's world, maybe microseconds, and others it may be months later that they finally respond to that information. So for us, the issue isn't so much just coming up with a concept, but it's coming up with these different return drivers, and then developing trading strategies that are around the return drivers. So the platform is designed for us to be able to back test any concept we have, any return driver that we have, and a big proportion of those are fundamentally based.
One of the largest, if not largest, hedge funds in the world, and I've seen the head of this firm talk about his approach, and he says, we are 100% systematic, but we are fundamentally driven too. I'm curious, does your lack of correlation exist also with the likes of a Bridgewater? It does.
And, I think Ray Dalio does share some of the same philosophy that we've had conversations with this, going back a couple decades, that Brandywine has, but that doesn't mean we're going to end up with the same strategies. There's just, literally hundreds, if not more, return drivers that are available to be exploited. They each have different time frames that they're applicable across, markets that they're applicable to. So the probability that they develop something that's identical to what we develop is pretty small. It's back to the monkeys on a typewriter trying to create a novel. It's reasonably random to expect that there'd be a high correlation between us and any other CTA or any other investment manager, including Bridgewater, even though we share the same philosophy.
Talk about the idea, though, when you say not purely quantitative for the audience. Where are you going with that? What do you mean exactly?
Well, we've got strategies that, for example, are looking at marginal cost of production in the commodity markets to determine when they may be reaching price levels that will be supportive. Whereas if you're looking at something that's purely quantitative, certainly trend following, and the market's is selling off to new lows, it's not really, it doesn't take into consideration whether or not the producers of that commodity are losing money at that price level. It just says the trend is down. I want to be short this market. Where a fundamentally based strategy that's looking at marginal cost production data is going to take a different approach. It's going to say we expect supply to come out of the market as producers start either losing money or their margins come way down and their marginal projects now are being abandoned. We potentially expect demand to come into the market because the price is low enough that you're going to see some support there and some extra interest in buying that commodity. So that's data that gets inputted into our models, and they're quantitative in the way that they're systematically followed, but and everything ends up being quantitative. We're not sitting there on a daily basis making a discretionary decision, but there's a lot of discretion that goes in the development of the strategy and the input points that are included in each of the strategies.
That was you already got my follow-up question, which was the systematic part. So I think I was thinking quantitative, not systematic, but you everything you're doing right now is 100% systematic.
That's correct. On the daily execution basis. In the development process, there are people that try to systematize the entire research process using neural networks, for example. We don't follow that approach. We actually do research and don't just rely on a computer to tell us what inputs are the most relevant. We need to understand the return drivers that are underlying each of the strategies, and that's a discretionary decision process in determining whether or not this is a valid return driver over something else, over whatever market time period we're looking at.
Mike, you've been in the asset management business, the trading business for a long time, many decades. How and why did this particular suite of strategies develop? What was happening with you as a young man? What was the influence, the inspiration? What got you going down this different path? I mean, obviously similarities, you're a systematic strategy, but different strategies. What were some of the triggers that got you started?
Well, I started as a discretionary trader, always upstairs, never on the floor, but looking at a variety of different inputs. And as much as I tried to come up with, and this is back in the early 1980s, and as much as I tried to develop trading strategies that were fully systematic, I never had confidence in the validity of those concepts and that they would continue to perform in the future. So I always inputted my own discretion, and I'd be watching reports coming out, money supply reports in the early 80s, for example, trade reports in the mid-1980s that were important influencers on the markets at that time. And so when I wanted to create a systematic approach to this, which was in the late 1980s, I never felt constrained to anyone's style. I wanted to include all this other information that I had been looking at on a discretionary basis in the same model. It took a few tries and a number of years before I started really kind of settling on the concepts that exist still to this day with Brandywine, the return driver based approach and the balanced predictive diversification portfolio allocation model that we employ. Those really kind of they formed out of that initial discretionary period, and then through probably a 3-4 year period in the late 80s into the early 90s, where we started creating the actual systematic trading model that we traded throughout the 90s, and that's really the core of what we trade in our Brandywine Symphony program today.
I'd love for you to dig in and give a brief overview of the 5 strategy types, but I think it's worth noting, at least from what I can see in your write-ups, there's no one strategy or market sector that dominates your performance. How does that happen that you keep this diversity in the performance? That there's not a particular return driver that really starts to be the secret sauce, so to speak, and the others kind of fall to the way. But you seemingly are describing to me what I see here is that something where there's diversity over time as to where the performance is coming from, and it doesn't just stick in one place.
Right. So, and we've kind of gotten away from talking about specific strategy types. We did that was a bit of an arbitrary decision we made, a number of years back to try to simplify our approach, is to say, well, you've got strategies that we can classify as sentiment, or some that you can classify as fundamental or event driven. And then we started finding that people had preconceived ideas of what each of those categories meant.
Yeah, it didn't help, right?
Exactly. So we spent a lot of time saying what we're not within each of those categories. So generally what we've gone and done when we make a presentation to an investor is we'll talk about a couple concepts that return that led to return drivers that we developed into a trading strategy, and then we can give some examples of here's a trade it made, so they can see how it actually works. But the key is that we don't have any one style that we feel should ever dominate over time in the portfolio. Now, at times, a certain strategy will be dominant because maybe other strategies aren't active, at that time. They don't find opportunities, so they're standing back from the market, whatever markets that are relevant to them. And then there's certain strategies that are more involved in the market, and at times there tend to be some correlation of performance of strategies, where some of the strategies that are maybe looking at money flows in ETFs are behaving in a similar way that strategies that are looking at marginal cost of production might be behaving, or that strategies are responding to different events. The release of the employment report is responding. And so you'll end up with pockets of time where you've got concentrations of positions in different markets, but over time, there's no design in the model that says we want to focus on a specific style or a specific strategy or a specific market.
Go back in time a little bit and talk about the development of a particular strategy. What I'm curious about is it's not about the optimal parameter set, but you're looking at establishing the sensitivity to parameter changes and the robustness of each strategy. Talk about what you mean there exactly.
So it's really important to get one of the key drivers of predictability of performance. And predictability doesn't mean it's going to be exactly the same in the future as it was in the past. It means it's going to have characteristics that are similar, that we don't feel that we're going to show 50% annual returns and all of a sudden we're going to lose 30% for the next 10 years. It means it's a little better at predicting. It's nothing's ever perfect, right? And you always have to disclose that. But so what we're doing is we're looking at like a basic concept and then saying, okay, is that a valid return driver? And if so, how can we capture it in its purest form as possible? Because and knowing that we're going to get really lumpy returns potentially from that by not adding a filter or incorporating another return driver to overlay on top of that to smooth those returns of that individual strategy. We just want to capture that return driver as purely as possible, because whatever performance we're seeing that strategy is having over the past then is more likely to recur in the future. And it's not dissimilar from people saying, I've got a trend following system, but I keep it very simple. I don't add a lot of filters or try to get out, reduce the losing periods by doing something. It's just, I leave it in its raw form. It's very similar to that. So you ask about an example. So in the 1980s, I traded a lot of markets based on events that were occurring. And in the early 1980s, which I alluded to before, money supply was a big trigger event for market action, and primarily in the financial markets, but it affected, it seemed like, a broad range of commodity markets as well. And when people saw money supply growing rapidly, they were anticipating inflation or they were anticipating higher interest rates. A lot of things were coming from that. What I was observing was that that event, the release of that money supply report each week, was something that was a relevant return driver over a specific period of time, a reasonable period of time. It wasn't specific. There's a range, but generally shorter term period of time across a variety of markets. What we've done since is start systematizing those approaches and saying, okay, what events are important? We'll have strategies that are looking at events for a decade and not signaling any trade in it, because even though it has potential for being important, it's not indicating in the market that it has been over that period important. But you'll develop a strategy based on that concept, systematize it, and incorporate it in the portfolio to be traded on a systematic basis.
You mentioned events, and I start to think of crisis type events. And so in the global macro world, in the trend following world, generally when things go south for the buy and hold part of the investment world, macro, CTA, managed futures, they do extremely well. I don't think your firm yet has, I think a 2011 launch, I believe, for Symphony, but I'm curious, what's your expectation for the crisis periods where you will see your performance? What's your expectation? Because we obviously have not had a real crisis period really since the fall of '08.
Right. Yeah. The closest we came, we launched in mid-2011, was the third quarter of 2011. You had some of the European stock indexes fall 20s to 30%. The U.S. stock market was down close to 20%. over a 3-month period, roughly. And we performed very well through that period. That was one of our stronger performing periods over the last 4 years now. But it's not necessarily that we're a tail risk insurance kind of fund. I think a pure trend follower, you might look at it and say, okay, we really expect a high volatility environment, negative environment to be positive for trend followers. It seems to be more of a tendency. And with us, it's more likely than not that we're probably going to perform well in those crisis periods, but our lower correlation in general means that it's a little more random for us.
Right.
But
right.
I would expect generally that based on what we've seen in just the last 4 years and trading through the 90s with a similar kind of product, that we generally do very well in those negative environments for financial markets.
I'm curious. So people listening, they're going to start to hear, okay, zero correlation to just about everyone and everything. And people that surely makes people tune in and say, oh, I want to know more. How do you describe the weakness? What's the weakness in your multiple strategy return driver set? Where is the potential problems that might unfold for you?
With any trader, I guess it's that we end up with too big a concentration in positions in any given market or group of related markets. That we try to alleviate that or reduce it as much as possible with our diversification portfolio, predictive diversification portfolio allocation model, but it's not perfect. So there's always these events that can be kind of almost random in occurrence that can come out and bite us performance-wise that we didn't anticipate. And when we say we expect more predictive performance, that means we're going to have drawdowns in the future, just like we did in the past. We just don't have the ability of predicting when they're going to occur or what's going to be the cause of them. A great example is recently we just suffered through our biggest drawdown. The Symphony program was down over 13%, peak to trough from the end of August to the end of January. So we had a 5-month period, 13% decline. It happened to be a period where trend followers just did extremely well. It was one of the best periods in the last decade for trend followers. We've had periods in the past where trend followers did well, and so did we. This just happened to be one where we did in opposite performance. It wasn't something we could anticipate. It just is something that certain environments will set up and will have that kind of negative performance.
But again, you're being very loud and clear from the beginning. You're saying we have zero correlation, so people should not expect you to have the same performance at the exact same time.
Right. And we did have some clients call and say, hey, this is a great period. The CTAs are making hay. Why aren't you? Well, we are CTA, but we are different. We're CTA because we trade in the same markets, and that's our registration. But the reason people tend to hire us is, first of all, they expect to have positive returns over time. Nobody, I don't think, puts us in a portfolio simply because we're not correlated. But certainly an advantage is that they've got other people in the portfolio who do tend to be correlated, and adding us to a portfolio adds a lot of diversification value at the portfolio level, having us in it.
Mike, and I want to kind of go a little philosophical for a second, and this is not meant as a critique. I'm just kind of curious your opinion, because any trader I could ask this question of. And you mentioned in some of your work, you talk about the idea of exploiting biases. All the great work of Daniel Kahneman, Vernon Smith. I mean, clearly your strategies are designed to say, yes, I know these human biases exist. And so I've developed some rules and some strategies to take advantage of them. Now, to me, as a speculator, I'm saying, well, I love that. I love that. I love that. That's crafty. That's clever. That's smart. That's skill. I like that. Some people might hear that and they say, oh, what about the ethics of that? The ethics of taking advantage of someone. And I think people often forget, especially about the futures markets, that speculators are not guaranteed a profit, are they?
Right. Well, I've never even internally faced the ethics issue, of it. I've just always believed in capitalism and free enterprise, and nobody's entitled to success. Everybody has to earn it. And if I find a way that can exploit, and I use the word exploit, these return drivers, which are based on other people's biases, then that's what I should be doing. That's what people hire me to do. I'm not in the business of saying, hey, you guys are looking at this wrong. Let me help you. I'm in the business of helping my clients, the people who entrust their money with me. So the fact is, there's bias. I have biases, and part of developing our models is trying to reduce the biases that I may have. In our current drawdown, for example, we had a number of investors. I had one in particular who called me right before the drawdown started and said that he was looking at adding more money and he wanted to have a 20-year view. And we talked about it extensively. I said, I can't estimate what's going to happen over a 20-year period. I do know we're going to reach increasing headwinds as we grow in asset size. It's going to be more difficult to execute in some of these markets. So whatever performance we're having now, don't expect that going forward. Everything was fine. And then we started entering into our drawdown. And this was an investor that literally contacted us at least once every day in the midst of the drawdown. His 20-year view shifted to 20 minutes. And that's the behavior that's part of the behavior that we want to exploit.
You sound so calm. You've got the inner something, because if you've got someone calling that much, that's clearly not good for business, in the sense that maybe the wrong client even.
Right, exactly. Yeah, no question there. And I've done a decent job, I think, in the business structure in insulating myself as much as possible from that kind of behavior, because I don't want it influencing my decisions. But I recognize that behavior is exactly what enables us to outperform. Over time. And as long as we're not doing that, and in many cases doing the opposite. And in my book, I published 4 years ago, the chapter 3 is what I refer to as the opposite chapter, because I talk so often, and so many of our strategies are based on this idea that at these emotional points, the majority of the people will be doing the opposite of what they should be doing to maximize their return. And so we're always looking at trying to figure out how we can do the opposite. So I don't want to turn into one of those people, and I've done everything I can over the last 35 years in trading to make sure that I don't become that I can exploit that type of behavior.
Yeah, so it's not necessarily fun that he's calling, but there's got to be kind of this wry smile where you say, you know what? That's why we develop the strategies, to take advantage of exactly what he's demonstrating by calling us every day. Right.
And it often, and in this case as well, it proved to be a turning point. That's when our drawdown was at its maximum. Since then it's come back quite strongly, and that's quite common, is that you see that behavior at a point where the maximum opportunity is being presented to you, if you can, on a disciplined basis, take advantage of it. And our discipline, and the reason we're systematic, is because I believe it's extremely difficult for any individual to overcome those emotional biases in those stressful periods by having a systematic process in place. And this is something I totally agree with all the trend followers on. You can follow that discipline. You don't have any question on whether or not you should continue to do something. It's in the system. It's what you should be doing, and you do it.
Mike, let me pick your brain on a couple more issues that I think that you'll have some good perspective on. The fixation by some on low volatility type strategies. They want to eliminate the volatility in the strategy. Talk about the human desire by some to try to eliminate volatility, and talk about what they are possibly really eliminating. They think they're eliminating perhaps risk, but talk about what they're probably really eliminating.
Well, okay, so a couple things. First of all, and I talked about this in my book too, volatility is not necessarily a measure of risk. So this focus on volatility might be a misplaced focus if people think that they're trying to control risk in their portfolio. The second thing is, you never want to focus on the volatility of any individual strategy. The only thing that matters is your overall portfolio, and what kind of drawdown risk or exposures or event risks you have in that portfolio. On an individual strategy level, it's extremely counterproductive in trying to control the volatility at that level. With us, all we're trying to do is capture the return driver in its purest form possible. And what that means is that we end up with individual strategies that have a lot of volatility. But we believe that over a generation, a 20-year period, a 30-year period, they'll capture that return driver in a very pure fashion. And if we think that return driver is valid, we're going to make money. And then you combine those strategies into the portfolio to lower the overall portfolio risk. So the main thing that's happening when people are trying to constrain volatility at a strategy level is, instead of capturing the purity of that return driver, which gives them a higher predictability of getting whatever that return driver is capable of providing over a multi-decade period, they're reducing that predictability. They're reducing the probability of capturing that return driver, and they're ending up with returns that are going to be less than whatever they're running on their back tests, for sure, and potentially a losing model instead of one that starts out as a winning model.
Mike, who is teaching these people to think like this? I mean, people will be able to listen to you on this podcast, and they've listened to you at other presentations, and there's many other traders that also have a similar type thinking. Who are the people that are placing money and assets? Where are they getting their training from? What's their thought process? It almost sounds like some of the most sophisticated allocators on the planet are like sitting in a boardroom sweating and afraid and perhaps just don't really know what they're doing. And I'm not trying to put words in your mouth. This is the crazy guy doing the podcast, but I'm just making observations.
One of our clients was talking about some of their clients, and he said, these are pension plans, and they have boards that are literally staffed with bus drivers. These aren't people that were even educated. And so what they're relying on are perhaps their consultants. And the consultants, as we learned in the financial crisis with people like the rating agencies, they're there to give the client what the client's asking for. So there's a lot of problem in the majority of the institutional marketplace, in that nobody's really coming in with anything innovative that could be better. They're just all afraid of either losing their job or losing their client by doing something that's different. And a lot of these guys may be academically brought up in more of an efficient market environment, and they don't want to deviate from that. They don't believe in return drivers potentially, even though a lot of what's being preached as far as buy and hold is capturing a return driver that's powering stock prices over a long period of time. You can break it down to that. So I think what you end up with are people that are more afraid of losing their job than they are of making money. And you end up with a lot of this groupthink. They start, I'll give you an example, they start defining risk in the wrong way. The only people that I could see that could have a substantial allocation to sovereign debt in today's environment are the people that totally misunderstand the meaning of risk. They're looking at saying, but it's a diversifier. It lowers the volatility in my portfolio to have 10-year governments, German bonds, whatever it is, in their portfolio to offset, say, long equity exposure. But at the same time, they're sitting there saying, actuarially, we need to make 7% in our portfolio. Well, as soon as they allocate 20 or 30% to the sovereign debt that's yielding 2%, they've added risk to their portfolio because their probability of hitting their target return is reduced. They lowered volatility, but that's not the risk. The risk is that they're not going to make enough money to pay out to the pensioners. And for whatever reason, it seems like this is just being missed by so many people in the institutional world.
I think I don't need to repeat it. I think you pointed out the ecosystem that exists with boards and pensions and consultants, and I think the audience can listen to a very succinct explanation from you again, and they can see quite clearly where the bodies are buried, where bad decisions might lie. Hey, I'm curious, because you talk about this a lot in some of your work that I've gone through. Give as broad as you can in our limited time. What is true portfolio diversification to you? That's a big topic, but why don't you take a chew on it for a sec or two?
Okay. Well, it starts out with being open to exploiting any return driver that is valid and can produce profit over time. So most people start with saying, I want to own stocks in my portfolio. Well, that's like a subset strategy within creating a diversified portfolio. So so many people immediately box themselves in with a couple things they've heard other people are doing that they want to then do. So it has to start with this open mind that I'm going to exploit any return driver that's valid and can produce a positive return over time. The second thing is then to say, okay, I don't want to have any of those return driver based trading strategies that I've developed dominate my performance over time. So you come up, and even though you may be biased and think that, I really like this sentiment strategy, it's back tested great. I think it's looking at measures and surveys of investors, AAII, for example, in the U.S. stock market, and from that I can come up with a strategy that's highly positive performance-wise on this back testing. Well, just because you think it's maybe better than your other strategies, don't over-allocate to that in the portfolio. You got to maintain balance in the portfolio. A third thing is that people tend to limit themselves to the markets they're trading. I don't know how many times I hear people say, I'm not going to trade commodities. European Union, the community, has memorialized this in code now to say that you cannot trade in commodities in UCITS. And for whatever reason, who knows, but somebody must have said, well, it's risky, so we don't want you doing that. So they immediately limit themselves to the markets that they can incorporate in their portfolio. And by doing that, you lower diversification. And then the fourth, it seems like the vast majority of the investment world talks about asset classes, and by that they mean taking long positions in groups of markets that behave similarly in similar conditions. As soon as you're constrained by asset classes and long-only trading, and you do not allow yourself to take advantage of the short side of the market, you've lowered your diversification potential in the portfolio. I would say that the vast number of investors' portfolios, and I use the term investors in quotes, I really view them as gamblers when they behave this way. I have long-only positions across stocks, maybe bonds, some real estate, and that might give them a tenth of the portfolio diversification they could possibly get.
So I've tried to pick your mind today on an assortment of topics that I know are dear to your heart. Is there anything I've missed that you guys have been talking around the shop in the last couple months that's been really on your mind or important? One of these things that I wasn't bright enough to ask about today?
Well, that because we went through a drawdown, over the last year, it raises new questions, and it questions the core of our beliefs. When that happens, is something happening this time that really is different than what we've seen over the last 35 years in formulating our belief system and our models. So if there's one thing that happens that emotions and emotions of drawdowns create, it's that requirement actually to kind of reevaluate and rethink. So I guess we're constantly questioning things. There's on our mind over the last 6 months has been these beliefs that we feel so strongly in. Are we the wrong guys? Should we be concentrating on something different rather than trying to retain this diversification across so many markets and in the portfolio and strategies? We keep coming back to we wouldn't do anything differently than what we're doing, which allows us to create more strategies and trade in more markets. So it's a pretty open envelope for us. Aside from that, there's really nothing new, I guess, that's been on our mind other than what we've been doing over the last couple decades now.
Michael, before I let you point people to where they can go, and I just realized in going through everything tonight that you had lost the fun title of your book, but I want to point out something, because I mentioned at the very beginning of this podcast that you were my first interview. Now, there are multiple places that people can go to listen to the interviews, all of my interviews. They never disappear. However, I will point out an anachronism with iTunes. iTunes only posts the most recent 300. So this means I need to create a second podcast for the episodes that fall off once I'm past 300 and I'm past 300. So your original episode will be on iTunes again, but it's never left the internet. It's in multiple places. If people want to go back and listen, it's on my website. It's everywhere. But I don't think I've mentioned before on my podcast that iTunes has got this quirky little system to where you can only have 300 episodes posted. So
well, that's impressive that you've got so many interviews up there, and it's pretty impressive what you've done there.
I appreciate it. So listen, where can we? The book is no longer got the original title, but the book is on Amazon still, right?
Well, you know what? It does. There's the book on Amazon is under Jackass Investing. don't do it, profit from it. It's still up under that. There's a second title that I called the professional title when we released the book, which is Exploiting the Myths, Profiting from Wall Street's Misguided Beliefs. I believe you can still get it under both titles, but the one that everybody bought was the more shocking jackass title. But it's the same book.
Do I have a memory of me and you debating titles before it came out? I somehow or another in the distant reaches of my mind.
Yeah, I believe we did, and I had it was a struggle for me because I wanted people to pick up the book, and I believed it had some impact potential as a book, and for a year, almost 2 years, we were the number one best-selling book on the Kindle in the mutual fund category and the futures category. So it did get some impact, which was great. But the criticism I would get was that the title Jackass Investing trivialized the content of the book. And I tend to agree with that. It is an issue, and I know it turns some people off because of the title. I've been told that by people who read the book and, subsequently said, hey, it was one of the best investment books I read, and I shouldn't be touting my own horn this way, but I would get that feedback.
It's a double-edged sword for the decision you made, right?
The title. Yeah.
Yeah. Hey, where can we send people to the firm to check you and the firm out?
At www.brandywine.com.
Okay. Michael, I hope you come on again in the future. Always love chatting with you. You sound crystal clear, too. We're like 8,000 miles away, and you sound like FM quality perfecto right now. I just
It's taken 20 years, but the internet's finally starting to work.
Yeah. Hey, Michael, thank you again.
Great. Thank you, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.